Today, I'm joined by Ben Thompson, the Deputy CEO of Mortgage Advice Bureau, listed on the London Stock Exchange, the AIM market under the ticker MAB. Been listed since 2014, and I'll be first and only mortgage intermediary listed on the London growth market. Ben, welcome.
Thank you very much for having me, and hello.
So, for those who aren't familiar with the MAB, can you give us a quick overview of what you do?
Yeah, sure. I mean, we're sort of in our own sector. We're known as a mortgage network, probably somewhat reluctantly on our behalf within the company. None of us particularly like the terminology, but it explains it quite well. Underlying the network, we have about 2,000 advisors that sit amongst about 200 appointed representative firms. So roughly 10 advisors per firm, which is bigger than the industry average. And in a given year, we help, I'll put it in numbers terms, probably about 140,000 people either move home or refinance, slightly more than that. It's about 25 billion pounds of lending, and that's split between people buying homes, refinancing, and we're also involved in sort of protection and a small degree of financial products outside of that. But fundamentally, we're a mortgage business. I would say in the city, from an investor perspective, rather than the trade name network, we're much more a platform. We're increasingly becoming scalable. Technology is very much at the heart of everything we do, and we're very different from our peers in that regard as well. So certainly, I would say from the city point of view, we're very much a platform now.
Okay, so you're more like a fintech company as opposed to a traditional mortgage broker or a go-between.
Yeah, and I was trying to avoid badges because they become buzz for a while and then they disappear, don't they? But no, we definitely are. So we're not just a mortgage broking mortgage network. We're significantly more than that. And maybe we'll uncover some of that in the next few minutes. But no, I'd say we're much closer to a platform or fintech, as you put it.
Okay, so is that what sets you apart from your competitors then, or what are the strengths that you have over anybody else in this marketplace?
Yeah, I mean, talking generally, from a technology perspective, many to most of our peers offer their members licensed technology, which is a monthly subscription, usually not particularly expensive, generic by nature, because it's offered across significantly more than one of our peers. And it's not personalized to that business. Now, if I then push that aside and say, well, that's roughly where most, if not all, of our peers are, we build our own technology. We've invested more and more year on year, despite the market conditions. And our play has been about trying to get firstly, our tech processes for our advisors and our customers the best experience possible. I'm sure we'll come back to that. But also, what makes us fundamentally different is we're sort of building technology tools to get our tentacles everywhere that people are looking for. Customers are looking for mortgage advice and mortgage information. So we're gradually sort of laying down the foundation. So whatever happens in the future, we can acquire clients all the time through our tech tools. And then we obviously, either the advisors feed on that directly or we pass that business out to them from the center, which makes us, again, very different than our peers.
Okay, that's interesting. So you're sort of hanging your coat there on sort of the technology angle. How is the technology improving sort of efficiencies or creating value for your customers? Can you give me an example?
Yeah, well, interesting you say customers in the question because that's where we start. Again, anyone who's been through the mortgage process in the last, well, been through it full stop, knows it. If you're moving home, it's quite a lengthy process. Now,
Mhm.
a huge amount of that we can control, and it's on our side of the fence. If I forget solicitors or conveyancing, the mortgage process we reckon takes about 10 hours. If I kind of look backwards, that's about right from front to finish. From our perspective, we've internally targeted ourselves through using technology to get it down to 5. And I'll come back to the customer point now. A customer being on the end of a 10-hour process is twice as good if it's 5 hours, yeah? Because they get
Yeah.
into the house and it takes half the time. Also, more importantly, from an advisor perspective, if I'm an employed advisor and I can get through the case twice as quickly, in theory, I can write twice as much business. From a business owner's perspective, I have a business that's twice as profitable. And if all our appointed reps and our advisors do that, then obviously we're twice as profitable and probably more on top of that. So at a very simple level, technology helps to give the customer a brilliant experience. Our advisors and firms enjoy the experience as well. And of course, from a financial perspective, we deliver better returns for our investors as well.
Okay, so would it be fair to say that you're sort of looking to do almost like a land grab then with the business? And is this how you plan to sort of grow or future market opportunities and sort of boost your revenue?
Yeah, and I think it's land grab, but not at the expense of margin. So I say that because today, within the last sort of, I don't know, 4, 5, 6 years, I know many of our competitors who we could, in theory, have bought. and then I could have said we're 22, 23% market share today, but what have I compromised through doing it? Well, margin's probably one of the points on that. So I think the path is clearing for us to grow organically at scale. There may well be some opportune M&A in there, and I definitely would not dismiss that. But from our point of view, the idea is to have a proposition that's the best in market, best in class, from a client acquisition point of view, from a point of sale process point of view, and also from a risk and compliance and governance perspective as well. When we complete that, it should, in theory, be easier for us to recruit more appointed representative firms into MAB, and of course, we grow more quickly. Add to that sort of the I'm going to call regulation a tailwind, not a headwind, which might be a bit unusual. But I think the weight of regulation for bigger businesses is something they can just about manage, but smaller and medium-sized firms will find it expensive and tricky. So I think there's an opportunity there to recruit more at MAB, also because the weight of regulation is now so heavy and the costs, pretty significant. So that would be our pathway to, I take your phrase, the land grab. Possibly some M&A on the way, and internally ourselves, so myself and Peter and Emily as a leading team, we basically set out 20% as a sensible market share for what we believe we can attain, and we sort of modelled and mapped the way to get there, and we believe there's a clear path, and that's absolutely the path we're sort of pursuing.
That's great. Very interesting. So tell me, you've been around for 20 years. You've been listed on AIM for the last 10 years, I believe. How's the housing market or the mortgage market in particular? How's that changed? And do you see it changing going forward, or is it stabilizing? You mentioned regulation just now. I mean, do you see that changing at all under the new government we've got?
Yeah, so picking up, I'll go into changes in a second. The regulatory bit it's a necessary thing that needs to be there, and it starts with the customer. So from our point of view, if we simply continue investing and trying to do the right thing, making processes simpler, customer outcomes better, our reviews and recommender scores are significantly higher and high all the time, then it really ought to be the case that we're complying. So if regulation is right, if customers are really happy and get what they want every time, the two ought to sit together, and that's the principle of regulation that I like, if that makes sense. So we're always going to be designing our proposition and all our thinking around that. So regulation, I think, a tailwind. It is a cost and everything else that goes with it, but also think it's the right thing. In terms of how things have changed over the last 20 years, it's phenomenal. And if I take a slightly different tack on the answer, the question I probably get most, or we get the most from investors' perspective and existing, but typically prospective new investors, is what's the worst thing that can happen to MAB? Tell me about what keeps you up at night. Well, the answer for me would be a pandemic, a credit crisis, significant hike in interest rates. Now, if I look at the three of them, I probably don't need to finish what I'm going to say, but we've had them all.
Yeah.
And if I sort of map back our growth since listing, but also pre-listing, which is even more impressive, we've grown double digits practically every single year despite that. And if I talk to the current conditions at the moment, literally within the last few hours, we've had for some what will be a frustrating base rate hold. Now the conditions for that, we know it's inflation and wages being stubborn and perhaps awaiting the US a bit as well. But the reality is mortgage rates are sort of 4 to 5%. It probably, even if that ends up being the new normal, we're going to be fine. And I think what the market sometimes misses is well over a third of our business is repeat revenue. There's a big chunk on top of that, which is protection. And then the rest of it is relating, say, to the house moving market, which most people get hung up on. So when the housing market outlook looks a bit flat and a bit dull, a lot of people just put a cross through MAB and think, well, they're going to have a tough time. Well, I would just say, look at the last 10 years, how the market share growth has gone, and the EBITDA and or sort of underlying PBT numbers we've pushed through at some of the most challenging times, so 2020 and 2022, 3 in particular. And the final point I'd make is we've continued to invest through that time as well. So in any one of the difficult years, so 20 and 23 in particular, if I got my years right, we could have just cut our spend by 3 or 4 million and blown through our numbers. The reality was, back to the point around technology earlier, we genuinely think the right thing through those difficult years to do is to carry on investing, because that's what will give us the clear water between us and our competitors and is much better for the medium and certainly for longer term. So that often gets lost as well. It's gone up year on year, even though the market's got tougher and tougher, and yet we're still hitting our numbers.
Well, that's really interesting, Ben. And looking at your numbers and everything, you've delivered pretty strong financial results over the years with a reliable dividend. And you mentioned there the challenges. How sustainable has your approach previously been going forward?
Yeah, so Dividends are, you remind me when you asked the question of something I'm particularly proud of from a business and a personal perspective as well. If I go back to 2020, it felt like the world was ending. If you remember, pre the vaccine, and I don't want to talk about the COVID world, but it was a horrible time, wasn't it? And I definitely remember we had to do all sorts of work around sort of planning and forecasting, times 10. And in and amongst all those conversations was the dividend. Should we just scrap the dividend? Were some of the questions we were being asked, or not, I wouldn't say advised, but it's questions being asked which were valid at the time. From our point of view, we felt we didn't want to let investors down. We paid from memory, I think it's half the dividend, but we also said at the time we'd make it good with our investors as well. Now, we had no idea at the time how long that would take, even though we're in a pretty good position. But one thing we wanted to do was repay our dividend to investors in full, which we did in the subsequent year, and repay all the furlough monies. We didn't take that much, but we took enough and we paid it all back. Then we repaid the staff all the wages which they'd sacrificed, and then finally we got back to business as usual after that. So I felt as a business we made the right decisions at that time. So that's my way of answering to you. I think from a dividend point of view, I have a high degree of confidence that even in a market that's shut for 4 months, we still did the right thing. And I would hope that's the worst condition I ever see in my working career. So I think our dividend is pretty strong.
Well, I think myself and all of the viewers will agree with you on that one, Ben. Listen, it's been fantastic talking to you, and I wish you all the best and success in going forward to 2025.
No, and thank you very much for having me on, and all the best as well.
Thanks.